We often start this story with the screaming. We shouldn't. We should start with the architect. The greatest boom in American history did not happen by accident. It happened because one man figured out how to sell the future, installment plan by installment plan. His name was Charles Mitchell, the head of National City Bank. He was the infallible architect of American finance. Before him, stocks were for the wealthy, for the quiet back rooms of Manhattan. Mitchell changed everything. He democratized risk. He took Wall Street and brought it straight into the living room of Main Street. He created the financial mass market, pushing bonds and stocks with the same aggressive marketing tactics used to sell vacuum cleaners. He was selling more than paper. He was selling faith. He promised a new era, a time of permanent, endless prosperity. Mitchell's genius lay in credit. If you wanted a stock, you didn't need the cash. You could buy on margin, put down a fraction, borrow the rest. A small investment today, secured by the incredible promise of tomorrow's perpetual growth. It was a brilliant, elegant, and entirely terrifying design. He made it easy to buy the dream. Here is the irony we must acknowledge. The Great Depression was not caused by a system that failed. It was caused by a system that worked exactly as its inventor intended. The mechanisms he built for the spectacular ascent were the precise mechanisms that drove the terrifying collapse. The same leverage, the same debt, and the same aggressive faith that fueled the boom became the engine of the bust. He built the ladder up to the clouds, but he forgot to include safety rails on the way down. He created the perfect machine for making money, right up until it destroyed everyone who touched it. Everyone loves the roar of the bull market. But what if the whole time the ground beneath the party was already shaking quietly? We are tracing the first crack in the foundation, the hidden trigger. While Wall Street danced the jazz age, celebrating astronomical paper wealth, a different story was playing out in the heartland. For the farmer, the Great Depression did not start in 1929. It had been underway for years. This is the story of rot setting into the foundation long before the roof caved in. During the First World War, farmers borrowed heavily to expand, urged on by high wartime prices. They bought land, they bought equipment. The instant the war ended, demand collapsed. Crop prices fell off a cliff. Now those massive debts, millions owed across millions of acres, became utterly unpayable. This was the invisible poison in the system. The money flow was perverse. Wealth flowed swiftly away from the farms and agriculture and into the urban financial centers. Wall Street called it liquidity. The farmer called it his life savings disappearing into a dust storm. When local banks failed in the countryside, they failed quietly. No front-page news. New York barely noticed. They were too busy enjoying the boom, betting higher and higher on the speculative fervor. They saw only the success of the few, not the structural weakness of the many. This is the brutal lesson the heartland teaches us. Wealth concentration acts like a blindfold. A booming market allows us to ignore a hidden, fundamental weakness in one sector, a weakness that will eventually become the tripwire for the entire economy. The financial foundation was not built on solid rock. It was built on deeply indebted soil, and the soil was already eroding. We ask why markets crash. We shouldn't. We should ask why we ever believed they would never stop rising. The Roaring '20s weren't built on steel or oil. They were built on paper and debt. This was the era of buying on margin. You put up 10%, your broker lent you the rest. Leverage. It's a sophisticated word for legalized gambling using someone else's money. The mechanism was financial, but the engine was purely psychological. Investors weren't operating on data, they were operating on envy and affirmation. This was a mass psychological cascade, a frenzy amplified by the newest technology of the time, the radio. experts, often unqualified, beamed relentless confidence directly into every living room. It was not merely greed, it was a collective hypnosis that the laws of economic gravity had been suspended. Everyone was rushing to join the in-crowd that was already rich, at least on paper. And when the herd runs, it only ever runs faster. But every bubble has a pin. In 1929, the pin was not a single event. It was the absolute, instantaneous moment the collective belief in up evaporated. When that confidence failed, the clock started ticking. The broker demands their money back immediately. That is the margin call. It's the final, brutal realization. Your empire of paper has burned, and now you owe the bank for the ashes. We always measure a collapse in dollars lost. But what did the financial apocalypse of 1929 actually sound like? It started with a roar. The trading floor in Manhattan was a coliseum, a relentless, deafening cacophony. Thousands of investors yelling, fighting for air. That was the sound of euphoria, quickly turning to panic. Underneath the chaos, there was a steady beat. The ticker tape machine. That relentless click, click, click tracked every transaction. It was the heartbeat of the market. Fast and steady, until it wasn't. On Black Tuesday, the panic volume went past 11. The ticker machines could not keep up. They fell hopelessly behind, sometimes lagging by hours. The crash was finished long before the machine printed the final number. Imagine watching a slow-motion video of your own financial ruin. The market was silent, waiting for the executioner's data. The system broke because of a simple, deadly mechanism, the margin call. What is margin? It's leverage, borrowing money to bet big on stocks. You put down $10, the bank financed the other 90. It felt like genius when the market went up. But when prices started to drop, that $90 became a liability. The broker demanded it back immediately. That demand was the margin call. If you couldn't pay the cash immediately, they forced the sale of your stock. This is where the domino effect began. Your forced selling drove the price even lower. That new lower price triggered my margin call. Then I was forced to sell. The chain reaction was instantaneous, interconnected, and brutal. The very mechanism designed to stabilize the system became the accelerant of its destruction. It wasn't a slow leak, it was a stampede. Millions of people learning the same brutal lesson at the exact same moment. In modern finance, everyone is holding hands. The sound of silence on October 29th was the sound of millions realizing how fragile their connection truly was. Connectivity became contagion, and speed, when everyone is running for the exit, simply kills faster. We all know the story of the Great Depression, right? Wrong. The crash of 1929 was not the disease. It was merely the loudest symptom. It was the spark. The real fire was the banking collapse that followed. We call this phase the Great Contagion. The virus was fear. For months after Black Tuesday, the market was wounded, but the system still breathed. The real disaster began when the money disappeared from the economy. It didn't vanish into thin air, it vanished into mattresses. This is the story of the bank run. Think about it. Your money is sitting in a safe account. Then a rumor starts. A small bank fails down the street. Suddenly, everyone realizes the safest place for their cash is under their own floorboards. It's a perfectly rational move for the individual. You secure your stack, you're prudent. But when everyone does the prudent thing at the same time, the system commits suicide. Banks, by design, do not keep all your dollars waiting in a vault. They loan it out. They rely on the assumption that we'll all leave most of our money right where it is. When millions of people demand their cash simultaneously, the banks have nothing to give. They fail. This is the anatomy of a liquidity crisis. Money meant to be flowing becomes instantly, completely frozen. The government had to impose the infamous bank holiday, not as a vacation, but as a forced pause. a desperate attempt to stop fear itself from becoming the primary economic force. We all ask the same question. Why did they just stand there? The nation was collapsing, banks were failing daily, unemployment was skyrocketing towards 30%. But the men in charge, the people who could pull the lever, acted like responsible yet ultimately paralyzed citizens. Their inaction was not laziness, it was an economic religion. The ruling belief was called liquidationism. The logic was simple, almost brutal. The system needed a purge. Let the bad debt fail. Let the weak businesses collapse. It's painful medicine, but necessary medicine. They saw the economy as a patient who needed to vomit before getting better. Herbert Hoover was the reluctant doctor holding the bucket. The second half of that disastrous